without further ado, I would like to start our session by having each panelist introduce themselves, including briefly stating who they are and what their roles in their companies.
Great. I will go first. I will volunteer. I am Chon Tang. I'm the managing partner of the Berkeley SkyDeck Fund. It's great to see a lot of old friends on this call. For those who don't know, Berkeley SkyDeck is the official accelerator for the UC Berkeley ecosystem. And the fund is actually an independent but closely affiliated vehicle that invests in up to 40 plus companies going through the accelerator each year. We are not backed by the taxpayers. We're not backed by the school. We're actually backed by private investors that buy into the thesis that that there is a massive pool of undertapped talent and deal flow that really can be only exclusively helped by the Berkeley platform. In particular, our focus, unlike most campus accelerators, is not purely on just tapping into the deal flow from campus, but instead more than half of the companies, and in the last year it's been closer to about two-thirds of the companies that we invest in have no previous ties to the UC. Instead, these are founders from outside of the US who are trying to plug into the ecosystem in the Valley. So in the 6 months that they're here, we help them with team construction, with biz dev, and of course with the fundraising process. Our demo days, which are of course now all commercial, are well attended with 600 plus investors at our most recent ones, and historically more than half of our companies have gone on and raised institutional capital.
Okay, I'll go next. This is Peter Shea. 大家小年夜快乐 Happy Chinese New Year. I am a general partner with Acorn Pacific Ventures. Thank you, ZGC Capital, for inviting us. Ella, it's been a while. I think definitely over a year that we've had lunch or coffee together. Acorn itself was established in year 2099 timeframe as one of the very earliest accelerator here in Silicon Valley, founded by a couple of very successful Chinese background entrepreneurs here in Silicon Valley. And just one sad thing is one of Acorn's founder, Dr. David Tsan, recently passed away. And he's started his company in the 70s, had company went public in the 80s, and throughout all these years. Acorn Pacific Ventures is one of the latest addition to the Acorn family. The family has originally company an accelerator here, and then went to Shanghai, went to Taipei, and then latest Acorn Pacific. So we have international footprint. Together through the years, companies that have either been started or invested by these great Chinese Americans or the venture fund itself have cumulatively created about $200 billion worth of companies. So it's a great legacy. What Acorn Pacific does right now is early stage up to Series B type of investment in anywhere near TMT, or also going into the healthcare space. I myself, I joined the venture capital world in 1997. So this is the 24th year that I've been in the venture business. I've done VC here for over 10 years and also VC in Greater China for over 10 years. I just came back here in 2015. So that's almost 6 years ago. So good meeting everyone. Thank you.
I'll go next. Welcome back, Peter. Good to have you back.
Thank you.
And, I'm a big fan of the Berkeley group. Hello, Chon. We haven't seen you in a year. Ella, thank you for having us here. This is almost a reunion of sorts. I'm Jordan Wahbeh, Silicon Valley Venture Group. Some of you know me as managing partner of Bay Angels, which left back in 2020 and started this group. The general theme of what we do, we invest in companies that improve the human condition. We look for companies typically in the B2B space that when I wake up in the morning or investor wakes up in the morning and they look in the mirror as they're shaving or they're brushing their teeth and they say, what did I invest in? And the company we invest in will be somebody that makes life and humanity better in many things. So the group is relatively new, but made of seasoned investors. We look at seed through Series A. We enjoy all B2B, tech-centric. We are focused on helping the companies that had the first wave of funding to move to the next level and beyond. Tech across the board. US is a great interest to us. We do look at South America and parts of Asia and occasionally Europe. It's a pleasure to see you all, and I see Gopi is on. So hello, Gopi, and thanks for being here.
Well, thank you very much. Ella, thanks for organizing this and moderating this discussion. It's nice to see familiar faces and new faces. I'm the founding partner at Sure Ventures. Sure Ventures is a Silicon Valley-based venture capital firm, and we invest in pre-seed, seed stage startups. The investments are made with a mission to enable peace of mind. What that means is startups that create products that create a better safety net, like access to insurance products, or technology solutions that modernize legacy infrastructure in industries like financial services, insurance, banking, and those kind of things. There are about 16 companies in the portfolio so far, and these are all companies that are in the very, very scary early stages when I invested. Many of them have gone on to raise follow-on funding. They're doing quite well. These are companies located in the US. Half of them are in the Silicon Valley, and the rest of them are located elsewhere. I've been in the Silicon Valley for more than 20 years. In addition to running the venture fund, I'm also an adjunct professor at INSEAD. I teach entrepreneurship.
Oh, thank you all. Those are really, really insightful information. And it's really like a friends reunion today using this opportunity. And thank you again for coming to this section. So now COVID-19 has brought huge challenges to our world that I have never experienced before. And there are a lot of things we do not really fully understand, such as how it shifts VC space in the near, intermediate term or long-term future. So my first question is, what is the impact of COVID-19 in VC world? And as a venture capitalist, how your decision and the investment have been affected by the COVID-19 pandemic?
I'm happy to go first, and feel free to jump in, my colleagues here. This is what happened with COVID. In March and April, everything came to a screeching halt. Nobody knew what was going to happen, how bad this pandemic was, what impact it might have. And many VC firms went into triage mode, tried to figure out which companies to save, which companies to fund. Almost all entrepreneurs decided that they need to raise money to make their business stable. So suddenly all my portfolio companies were fundraising just to make sure that they got a bridge. So that was a very unusual experience. But very, very quickly, by the end of May, things settled down. And this is what's something that unique I've never seen in my venture career. Some of the boldest entrepreneurs really stepped up and they took advantage of the opportunity and they doubled down on digital transformation. And that really fueled growth. And out of that came a whole bunch of startups, Zoom-like startups that really escalated to the stratosphere, and they grew so big, so fast, beyond anybody's expectations. You wouldn't even think that there was a pandemic going on at that time. Like, that's the kind of growth I saw. So by the time we got to the end of the year, things were kind of almost back to normal. The only weird thing that happened was all the deals were now happening remotely. Meeting people in person, it never happened, and it still is not happening. So it's kind of bizarre to me that this whole year has been on one end of a pendulum, really scary, and on the other end of the pendulum, the best leadership I have experienced, I have noticed, having the front row seats as an investor, watching all these entrepreneurs tackle the situation. It's incredible.
I concur with that, Gopi.
So go ahead.
Go ahead. So same thing. I mean, COVID is a terrible, horrible, evil, completely disgusting thing, but it's been very good post April and May. I think it's as if Mother Nature came to the VC door, says, knock, knock, wake up, get your stuff together. At the point of this regeneration Gobi described, many of the weaker companies have dropped off the map, which gave more oxygen back to the existing stronger companies. From a VC point of view, from an investment, I think it shifted the focus, and the priority went into something that is more tangible, more likely to provide value. And I got a sense of urgency in most cases that the investors are now more focused, more serious on the fundamentals, and a lot less on the dog and pony show. The Zoom culture has been good to many companies. It eliminated the need for capital and expenses to travel and to fly to San Francisco to have a 15-minute meeting and then fly back. It created the sense of we're all equal in the eyes of this virtual meeting, and the real companies start to step forward, and I start to see real companies come forward. So it was sobering, focusing, sense of urgency, and in my mind, it gave more oxygen to the ecosystem to really look at the companies that are really worthy of attention. So I'm sort of happy.
I think that Gopi and Jordan have already given a very good overview, but I'll give a slight counterpoint for some of the founders out there who might be saying, hey, I've been going through this process for the last year and I'm not seeing the investor interest. I'm not seeing those term sheets. What I've really seen is, I think of the investor ecosystem as being very bimodal at this point. Historically, it's been a bell curve, right? For if I think of just the companies going through our program who then go on to raise institutional capital, it felt like as long as you had those early signs of product market fit, as long as you were aiming in the big market, you could expect a term sheet. It was very clear, and there was pretty common, well-known terms for what that first institutional round could be. You know, $2 million, $4 million for a quarter of the company. Very, very, very common. What I've seen post-COVID is that there's now been a new bar that's been raised. It's no longer just about proof of revenue. It's no longer just about any of the casual signs of product market fit. It's much more just an overall sense of risk. You know, how comfortable am I feeling about you? How comfortable am I feeling about the industry that you're involved in, being here in 2 years and 5 years? And because of the interactions with investors are all over Zoom, I've seen a lot of companies that have hit the revenue numbers not be able to really raise that first round. It's frustrating. But on the other hand, for the companies that do clear that bar in a very not so concrete way, it's hard for me to articulate where that bar is. I just know that it clearly exists. For the founders that perhaps have done this before, for the founders that have a strong personal brand that go through our program, when they raise, now their valuations are actually significantly higher than what they used to be. So for those of you who are confused and saying, hey, I hear from investors, I read on TechCrunch about these amazing rounds that are being done in the seed and the A stages, it's not a lie, it's occurring, but unfortunately the bar that you have to really clear in order to really tap into that pipeline has gone up. And I actually think that when we can go back to being in person, and I really do expect that post-COVID, I assume this is a topic that we can talk more about. I do believe that fundraising will go back to being in person. And at that stage, I think that the two bimodal distributions will then merge again. And we will see companies that are interesting be able to really raise on the merits of their business itself instead of just purely this overall sense of comfort.
So I'll draw some experiences from previous disasters. Year 2001, I saw a lot of play-to-play term sheets here in Silicon Valley. And in year 2003, I started seeing my friends in China trying to, I mailed them N95 mask in 2003 because of SARS, but they could not receive it. And I vividly remember one morning I purchased N95 from an outpost here. In the afternoon, I wanted to buy a second batch, no longer available. And then fast forward to 2008, when I was doing VC in China. Of course, then all countries' government printed a lot of money. So when COVID hit, my immediate response was, is this going to be as bad as SARS? Looking at what happened in China and then subsequently the rest in Asia, I got very scared. And then quickly, I started challenging myself whether we're going to see a lot of pay-to-play type of term sheets. And indeed, we started seeing some. So my conclusion at the time was, it's going to be the worst of both times. And what happens is moving forward, situations seem to have turned better. In boardrooms with a lot of my portfolio companies with other different boards, we were discussing, is it going to be an L shape? Is it going to be V? Is it going to be W? And quickly, Beijing contained a lot of the virus situation, but Dongbei, the northeast part of China, started having some. So we were saying, okay, it's going to be a W. But we never knew that US government is going to print so much money here in the United States. So stock market is going this way. In a lot of cases, some companies' valuation is going this or slightly down. Fortunately for Acorn, of our 20, 30 portfolio companies, none of them have died during this period. So I think we are on the lucky part. People say it's a K shape, right? You have the arm, you have the leg. Fortunately, all Acorn's portfolio are on the arm side, which is going up. But now that we look back, we're still in the middle of COVID. I still don't know when it's going to be over. I don't think anyone, of course, we trust a vaccine is going to help us with some. But globalization, virtualization, behavior, industry is all going to change, especially if you look at a lot of performance are still doing very well, starting with B2C, migrating to B2B and cross-border. What I urge and I look at this situation is we need to be able to identify what are the long-term effect of COVID and what are the short-term effects in COVID. I think a lot of the behaviors we see recently, for example, on the stock market are short-term, but longer term, you still have to go back to fundamental. But how long that term is going to be, we don't know. But as long as COVID is with us, I think the jerk from COVID to affect our short-term behavior is still going to remain. Yeah, virtualization, globalization, all those terms you see on Wall Street Journal every day. Thank you. Yeah.
Yeah, wow. A lot of quite a story. It's a lot of information. Thank you all for the sharing. It's really also a valuable opportunity to hear all this direct insight from investors coming from a really diverse and also unique background. So now we want to switch to startups angle. Since the start of crisis, VC funding dropped like 20% worldwide, and a lot of startups are dying. So for startup, this is a really difficult time. A lot of our today's audience today are entrepreneurs. So can our panelists please give some advice to our startup audience? What can they do to survive and thrive the COVID-19 crisis?
I'll go first this time. I remember one interview, then famous CEO of Cisco, now also a venture capitalist himself, Mr. John Chambers, said that, I just wish, my advice to startups, or if I were a CEO, I wish I could cut fast enough. Whenever I advise my startup CEOs, I tell them, you want to do to the extreme in terms of what you can control. What you cannot control, you want to wish that you will work hard on it and wish you have good luck. But whatever is within your control, do it very, very well. So my immediate response is CEOs will always come back to say, it's so hard to recruit this great team. And we spend a lot of effort through the years to hire these people. But I tell them that assuming situation goes on, you need to establish several milestones for yourself, beyond which, what are the actions you want to take? So these are the controllable items that one wants to take. The other thing in the beginning of COVID, of course, we're still in the middle, is if you receive not VC term sheet, but if you do receive any venture debt financing type of term sheet, try to take it, because that's money on the table. Keep your company alive. That is also very important. Other things is this is a good time to start establishing controllable milestones so that you can pitch to investors. I've already talked about cutting expenses. An interesting thing to consider at this moment is either for your company to be acquired, or for your company, if you have enough war chest, to acquire other companies. Also, this is not a bad time to consider strategic investment from strategic investors, either from the industry or from different geography. Also, I think since a lot of things are moving slowly in this situation, it is not a bad time to have most of the executives to spend one day or 2 days together to clearly reevaluate what are the biggest important and also urgent value proposition the company has to its customers. Realign so that you have a laser focus on your product offering. And last point I would like to bring to the table is, yes, in order to cut expense, you may have to do some restructuring of the organization. But on the other hand, this is not a bad time to hire good talent to replace some of the non-performing members in your team. Thank you.
I thought that was great, very practical tips from Peter. I think I don't think the rules of the road for building a good company have changed that much just because of COVID. You're still going out there making sure that you talk to customers, you make sure you fall in love with a problem, not fall in love with a tool. That's really going to be the bottom line with or without COVID. One specific point of advice as it comes to the COVID era, I've seen a lot of founders pivot their story and their thesis to be very, very much focused on COVID as an ongoing theme. And I don't think that's correct. I think clearly there are some lasting trends that will be here for years and years and years. The impact on how we work and how we interact, that's going to be here. But if you're specifically focused on COVID testing, if you're specifically focused, just to throw one example out there, I saw a company recently that was focused on the story of, hey, what if kids were being taught online exclusively for the long run, for 3 years, 5 years, 8 years and beyond? I'm pretty confident for all the parents out there, all of us are desperately waiting for the day that our kids can be back in school. And as soon as that happens, we're taking away their iPads and they're not going to see it again for five years, right? So make sure that you have that long-term perspective. We are going through an exceptional period, but by all indications, from a market from a go-to-market, from a customer perspective, that exceptional period will fade away soon, I hope.
Let me pick up where Chon left. I'm going to focus on the emotional intelligence portion of the business because Chon and Peter gave great advice. If you think you're on the bottom 50% in terms of survival, I don't have any good advice for you. It's going to be bloody. It's going to be brutal. If you're on the top 50%, I learned from Gartner back in May, there's going to be a sinusoidal cycle. It's going to be harsh COVID conditions going to get better, then them harsh going to get better. And I'm seeing exactly what they predicted almost to the month. So this, in my opinion, is 2 years out. It's at least 2 years of up and down with the vaccine and everything. It's not going to just blow over magically. So change your mindset. Plan for 2 years of COVID conditions and establish as many alliances and partnerships with other fellow non-competitive partners, startups, organizations. So you could do some sharing of resources and some collaboration to extend your dollars and extend your resources as much as possible. If you're doing any funding, plan for longer cycles. The old metaphor, let me get 6 or 8 months worth of funding and then come again. I don't think it's a good investment of your time, given that you don't know when the next storm is going to hit. And I would definitely do quarterly review of my business models and my market conditions diligently. You know, it's a come to Jesus moment every quarter. Are we doing the right things? Like Peter said, key deliverables and so forth. Face reality, guys, if your industry is in shambles, you know, it's okay. You know, pivot, get out. If you're in the hospitality industry, if you're on the, you know, it's time to say, what else can I do? And I worked with Cisco. I know exactly what John was talking about. He would make the cuts fast. So make the cuts fast. Faster decision-making is going to be your best asset for the next several quarters until you get a sense of stability. I don't want to suck up all the time. So back to you, Mr. Gobi, my good friend.
I just want to add one more point for the cut from John Chambers. In other descriptions, people will say, if you want to cut only once, but cut deep. Don't cut it multiple times. That will affect the morale of the company. Sorry for interrupting. Yeah, back to you.
That's a very good point. You want one clear, strong, deep cut and then recover from it versus 1,000 cuts along the way. That's torture. I don't have anything significant to add to this. I think the brilliant minds here, we've all covered many interesting topics. We can move on to the next question.
Let me go back to the cuts. John, and all his wisdom, he had 100 super smart, intelligent people, and he was running a $65 billion company. You're not. So yes, make a cut once, but maybe you do a couple, make a good cut, see how it works, and then make another one. Don't throw the baby with the bathwater. So yes, I agree, not 16 cuts, but just somehow know that you don't know most things that John knew when he does his cuts. I remember John and what he did, and it was
awesome. Okay, wonderful. All the valuable advice, and also hope our audience find this helpful as well. So let's switch the gear to the technology itself. We're now experiencing the most significant changes in the last 100 years. And during this time, many older businesses will transform and new business will emerge. So the question for our panelists is, what do you think the future trend in innovation is after the pandemic? And where can you find your next unicorns?
Oh, where can you find your next unicorns? I wish anybody had an answer to that. I don't think anybody has that answer. I'm looking for it as well. But I'll tell you a few things. Now, the first thing is legacy industries are changing. If you look at the history of how Silicon Valley evolved and how startups built transformative solutions, it started with ad tech and then moved into telecommunications and one industry after the other. But now I think we're getting to a point where we're hitting some of the largest industries that are stuck in Stone Age with very old infrastructure like banking and insurance. And sometimes even we're hitting on government and those type of areas. The way we built startups in the 1990s and early 2000s, that's not going to work in 2022, right? 2022, 2023. So if you look at the next couple of years, the kind of startups that will thrive are the ones that understand how to capture a portion of the legacy industry and transform that industry, or perhaps even create a new subsegment in that industry. The beauty is that some of these sectors are multiple hundreds of billions of dollars, or maybe even trillions of dollars. So even a small niche, like for example, in the insurance sector, is $1 billion. So it's very easy to build a business that will capture a portion of that market and perhaps even create a new products using the technologies that we have. That's what I'm really excited about. And I think that's where the next set of unicorns, the future Google, Amazon, Netflixes of the world will come from there.
Well, I'll go next on that topic. I will take the question of where, as not in terms of the verticals, but where in the world. And I think from that point of view, I'm certainly biased because this is our thesis. at SkyDeck, but I really do see entrepreneurship continuing to soar on a global basis. You know, more than ever, people are trapped at home around the world, not just here in the US. And in that process, I think they're reading more, they're thinking more, they are changing the way that they work and that they engage. We've already seen, so last year, close to 3/4 of the companies applying to our program were global. A lot of them were coming from Europe, from Latin America. I don't see that trend changing at all. And obviously, all of the often talked about themes of capital being distributed more effectively. We see lots of new investors going towards Europe, towards Latin America. These are all very positive trends, and I think all investors need to take off, you know, from a point of view of being focused exclusively on what's going on in the Valley. It's already occurring, but all of us need to work even harder to make sure that we have that global view.
Okay, then I'll try to go next. I think when during this COVID period, staying in front of computers and reading books and so on and so forth, put a lot of thought into what's going to happen in my investment thesis. What I have waken up to think about the situation is when I approach a new investment, I would look at this industry, whether it's a more mature industry or it's a emerging industry. In a more mature industry, it's going to be lots of M&As, and the larger players that are already established. For example, we talk about semiconductor, capital equipment, then it's Applied Materials, it's KLA, it's ASML, right? These companies, or in the EDA industry, it's Cadence or Synopsys. Most of the startups that are built is going to be merged or acquired by these larger companies. If not, then this startup is not going to make it. But if it's in a new industry that's emerging, then you can still have a lot of new application that's taken place. You are able to build a lot of large companies that have its own platform. But during this COVID period, I think a lot of the good and interesting multi-billion-dollar IPOs are consumer related. Meaning, if you look at companies that are supplying technology or infrastructure, application, or user interface convenience, I think a lot of the second and the third layer companies are going IPO now. The only difference is back in Asia, we do see a lot of healthcare related technology companies that are going IPO in Hong Kong in billions of dollars of valuation. So I think if I look at it, I will be looking at in what industry and also in what geography, whether it's a platform company or whether it's just a small play to be acquired. That's basically what I want to bring to the table today. Thank you.
Thanks, Peter. Yeah, I agree, Peter. A lot of the IPOs are consumer driven. I think the enterprise class is a lagger. In my opinion, COVID has created a demand for consumer because of all the things Peter mentioned. The enterprises are moving in the direction of reinventing themselves in the COVID area. I don't think we are in the post-pandemic times yet.
Not yet.
I look at the world in 3 stages. I look at it in BC, DC, and AC. BC is before COVID. DC is during COVID. That's our age. And AC is after COVID, and I'm not sure when that will happen. So we don't know, but it'll get clearer in a few cycles. Tool companies, you know, social stuff, working apps, the likes, they're not going anywhere in my humble judgment. But the enterprise class, I think, is going to thrive in 2022 and 23. That's a great area to invest. Fundamentally, Peter and Chon and Goopy, healthcare, fintech, the Zoom culture. But don't forget about the millennials. These guys are getting older. The tech is their second name. You know, there is no hesitation to adopt technology. 50% of them are over the age of 30 something. They're making more money. Their life is stable. If that's the target audience you want to go for, there's opportunities there. And surprisingly, in the age of COVID, behind me you see something going up to outer space. Space tech is a big big space. It's not about rockets and astronauts. It's the entire industry of logistics, transportation, enterprise software, all sorts of things to manage the business of space. I have a big bet on space. SpaceX is going to put 1,440 satellites in orbit by the end of 2022. They're selling satellites, they're selling time. That's also going to need support. Think of it as how Uber is getting all these elements of support. That industry is going to need a lot of auxiliary support, and it's a big bet. Of course, what do I know? I'm just sitting here on a Zoom call talking to a bunch of people. So.
You look like a rocket scientist. Jordan.
Wonderful, wonderful sharing. And some of our panelists already mentioned about seeking investment opportunity from other part of the world. So now that COVID-19 is a global crisis, so our last question for the panelists is, what are some opportunity in other parts of the world, such as Europe, South America, or China, compared to USA, regarding funding, technology, innovation opportunities?
That's actually very, very interesting to me, because I had my annual investor meeting for my investors, and I had a slide which I had prepared many months earlier, and I showed that 50% of our portfolio companies are in the Silicon Valley. But when I looked at every logo, I noticed that they're actually not in Silicon Valley anymore. The founders have moved. So many of them are in Florida and other places. Some of them are even outside the country. So, I know that I introduced my firm as a Sure Ventures, Silicon Valley-based firm investing in startups based in the US. I think that sentence makes no meaning anymore in the future. Founders are where they are. The right way to look at it is, where can you build a business? Where are you comfortable? Not just for yourself to build the team, but you need to have family that supports you, an extended family that creates the environment where you can unleash maximum entrepreneurial potential. And if that's in South America, let's go there. And the founders will be located there. They will just do that. Investors have no control. Investors have to go to the founders. And that's the new age of venture capital. Unlike the old age where Silicon Valley investors would demand that the entrepreneurs move their family to Silicon Valley, close to Sand Hill Road, and live there. That's gone. So the question of where is the future of venture capital? It's everywhere in the world. It's probably in the cloud, not in any one geography.
Well, it's not fun if all of us agree all the time. So I will take the counterpoint. I sort of believe that the funnel, the front of the funnel will be global. I certainly believe that people will live and work in a global virtual way. But I'm actually more optimistic from a fundraising perspective, or maybe you can call me a pessimist. I actually think that fundraising will continue to be more geographically focused. And here's the reason why. When if you put yourself in the shoes of a founder, if I told you that there was a 1% improvement in your probability of getting a term sheet because you had a chance to meet Gopi in person, because you grabbed a coffee with him, you grabbed a beer with him, instead of just having a Zoom call with them, I think for a lot of founders, they would do it for that 1% improvement, because of the implications of getting that term sheet, because of what that brings to their company, to maximize the probability of them being able to achieve their dreams. Even that 1% improvement is worthwhile. So this is just a guess, and it wouldn't shock me if it turned out the other way. But I think it's quite likely, quite possible that in a year we will see fundraising still occurring on Sand Hill Road, even while the companies themselves are not here.
Chong, I agree with you that the 1% story, that's true, but I'm going to flip it a little bit. If there's a 1% chance that I can invest in a unicorn company by traveling to Beijing, I would do it. I'm not going to wait for that entrepreneur to come to Silicon Valley to meet me. I would rather take that flight, go to Beijing, and convince that entrepreneur that I can add value and they should add me to the cap table. I think that's the world that we're going to. I have no doubt about that. But I'll make the case for why Silicon Valley as well, because I think it's relevant. For entrepreneurs, because they're going to be distributed all over the world and success will come from any part of the world, it's very helpful to have a firm like ZGC or someone that has roots in the Silicon Valley. If the entrepreneur is not going to be here in the Silicon Valley, it's very helpful to connect with an investor who is in the Silicon Valley, because that person will be in the flow of various pieces of information, future round of funding, talent, and various other things. So it's it will become more important to have a Silicon Valley based or Silicon Valley networked investor. And that's going to be critical for the success of the company.
Interesting. May I jump in, Gopi? So follow-up question. So from your perspective, you will now where you are quite reluctant to invest in company before you see them in person. So despite of all this online virtual discussion, all this paperwork exchange, you still would not really feel comfortable to invest them until you see them in person.
I prefer to see the spark in the eyes of the entrepreneur. I am comfortable making investments remotely. Venture is a different kind of business. Investors don't spend time with entrepreneurs on a weekly basis, on a daily basis. In fact, beyond the Series A stage, board meetings are the only times that the investors and founders meet, and that's 4 times a year. So because of that, the transactions are already set up for remote work. But now if you push that to 100%, you'll never ever meet the entrepreneur. That is tough. That is very difficult. I would prefer to meet the entrepreneur at least once or twice before the investment's made.
Yeah, I think Silicon Valley, at least in the short run, is not going to be replaceable. Number one is just like what Chon said, co-investment opportunity. You want to co-invest with people you like, you trust, you've done business before. And so that when he presents you a deal, or you present him with a deal of your investment, they would look at it closely. On the other hand, is also, say we're also used to Zoom meetings, but there's one aspect Zoom currently still does not provide, at least me. Maybe this is a market opportunity, right? I like to see how the team, other than just the CEO, work together in that conference room where I'm sitting at. I remember there was this once, the CEO was a great, very good performer, I would say, use the word performer, did a great job. But when his vice president, I think was in marketing or in sales, was trying to help, you could see immediately CEO change his face and yell at the guy, "Shut up, I am talking." Therefore, you know that's probably not the right company you want to back. In a Zoom setup, it's so hard to observe these kind of dynamics. And also other situations are, for example, we don't have real handshake now. I like to do handshake to feel whether it's moist, it's warm, it's cold, or even from a Chinese background, I would also want to see when the guy is talking to me, is he shaking his leg, for example. All these small micro movements, dynamics here and there, just like when I listen to music, I'd like to open all my antennas and observe. I'm missing those here in Zoom. Yeah, so I don't think Silicon Valley is immediately replaceable. But on the other hand, if the trend is going to move over there, it's going to be distributed. It's going to be more virtual. The only big thing that and supply chain is going to change, of course. The only thing I still do not have an answer is, maybe Ella, you have the answer, is China's birth rate has dropped so significantly that China, I don't think at least the mid-run is going to be the factory of the world. Who is going to replace that? You do see a lot of supply chain moving down to Southeast Asia, but a lot of them either do not have the culture or not enough even population to replace China. So I don't know how supply chain is going to evolve. That's my biggest question on how the fund. Remember I said 3-layer, the technology infrastructure, the application and user interface part. I don't know who is going to sustain the bottom part. Yeah. Thank you.
Peter, I've got a company in LA that could read your whole body and give you full interpretation of the sweaty hands, the shaking foot. And if you're willing to invest, I will make the introduction right after this call.
I am still that old style. I want to invest someone that's close to me, even though I'm willing to do Zoom. This is the difficulty. Maybe I like the company so well, but I will worry that how do I find co-invest for him for my next round? That's what Chon was bringing to the table here. But I do, if you don't mind, you can share the name. I would love to take a look at their website.
I will do that.
Thank you very much.
I'm going to look at this in two buckets. One is where the markets are, and then this business of Silicon Valley. I think the intellectual center may remain Silicon Valley for a while. It's the knowledge, it's the networks, it's understanding. One of the folks said it's less about being physically here and do you have the right network in the Valley to help you move. The Valley isn't about money. It's really about the intellectual property, the network, the movement of your company from point to point to point through the vast knowledge in here that allows people who come here to be very successful. The pre-COVID, I would discourage many companies to come to the Valley. So there's real value for you in Valley in not being here. Not just the money, very distracting. It's a circus. If you come here and try to start a company, you're just going to be sucked into this atmosphere that this allows you from being efficient. So there's pros and cons. So we're in the big pause. The big pause is COVID. We still haven't gotten out of it yet. It's not going to be like the end game, big blip, and then everybody comes back. It's not going to happen that way. It's going to be something else. So for us, when we invest and we look at companies, geographically, we try to find co-investors, people in that environment who can interpret and transfer knowledge about the physical market, about the demographics, about the economy, about the people, so we can have a better understanding of what is going on in that market. I think South America has great potential. It is, don't look for a unicorn and $1 billion or $100 million. It's not going to be there. But there's a lot of copycats, me too, who would take something, localize it, and they'll do really well. And you could make real money there. Africa is up and coming. In certain sectors, Africa is a gold mine if you are willing to deal with the localization elements, and nothing wrong with that. So I would look, if I'm to look somewhere outside the North America, South America would be great. The time zone, etc. Africa would be second. I'm not proficient in the Far East, but Peter is probably going to be a good partner for us if we do anything like this. The Middle East has excelled. For example, Kareem was the Uber of the Middle East, and they got acquired. They are a unicorn, a souk, about 3-4 years ago. They copied Amazon. They were acquired by Amazon. Look for these companies that can Me Too, expand in the region, grab them, run with them, and they eventually become your 5, 6, 7, 8, 9, 10x multiples. If you're listening, Me Too is not a bad thing if you do it right.
Okay, wonderful. It's really insightful session, and I really hope we could have more time to expand our discussion. There's a lot of questions I want to discuss with you, maybe in a different time. So now we come to the end of the panel talk, and I would like to thank again to our panelists for the wonderful sharing today, and hope our audience find this panel helpful as well. Thank you very much.
Thank you, Dr. Ella, for having us. This has been a great opportunity.
Yes.
Yeah, thank you, Ella, for the invitation. Let's do this more. Yeah.
Happy New Year.